Well, here we have a real short segment in corporate finance on financial statement analysis. It's actually a single learning outcome statement. It says the candidate should be able to demonstrate the use of pro forma income and balance sheet statements. So let's take a look at this and get familiar with this idea of pro forma statements and sales-driven forecasts. Our pro forma financial statements, we're going to estimate the relation between changes in sales and changes in sales-driven income statement and balance sheet items. As an example, think of costs of goods sold. If we predict sales are up 10%, it'd be pretty reasonable to estimate costs of goods sold are up 10%. If we know we can produce another 10% without changing our factory, then our fixed assets might not be driven by sales. So once we do this, then we estimate our future tax rate, interest rates on debt, and lease payments. Now some of these forecasts and estimates can be very simple. We might just take last year's effective tax rate and use that as our estimate for next year. In a more sophisticated or complex analysis, we could look at changes in tax rates over time. We could look at the reconciliation in the footnotes between the statutory rate and the effective rate, find out which countries we're doing business in and that have lower tax rates, and is more of our growth in low tax rate or high tax rate countries. My point here is that all of these estimates can be very simplistic or very complex. And I'm not sure there's a guarantee that the more complex methods are better, but we can hope that they are. So once we do this, then we've got to forecast sales, and we'll talk about how we might do that in a second, and then estimate our fixed operating and financial costs based on that level of sales, and integrate all these estimates into pro forma financial statements, down through an income statement to net income, retained earnings to the balance sheet, adjustments to debt accounts, inventory accounts, whatever on the balance sheet, and get these two to agree. So how might we estimate sales? Well, we might look at the last 5 or 8 or 10 years and look at how fast sales have been growing as a compound rate. That's one way. And just say, well, we've had sales over that 10-year period grew about 6% a year. Let's figure they'll be up about 6% next year. We could also do a regression analysis. Wouldn't be uncommon to regress our sales on change in GDP. That is, our sales change has some relation to overall economic cycle. So we do a regression analysis to estimate that relationship. Then we'd have to plug in a forecast of change in GDP for next year and then use that regression or slope coefficient to estimate the change in our sales based on that estimate of GDP growth or decline. Now, if we have specific events, if we're going to add a brand new product that we think is going to be huge, then we might want to put that into our sales estimate. Another way is to look at the individual segments of a business and do sales estimates for each specific segment because they may be affected by different factors, and then sum all those to come up with a total revenue number for the firm. So let's look at a simple example of how we do a pro forma statement. So say our actual for 2007 is $30,000 for sales. Our costs of goods sold were $12,000. SG&A, our selling, general, and administrative fees, $9,000. Operating earnings, $9,000. Interest, $5,000. Earnings before tax, $4,000. Tax, 40% of that, $1,600. Net income, $2,400. So now we're going to do a sales-driven forecast for the next year. So our percentage increase is 10%. So we increase sales. Well, if we assume that costs of goods sold are going to remain at 40% of sales, then they go up 10% as well. And if we assume that our SG&A is going to remain at 30% of sales, then that increases 10% as well. Now we use those to calculate our EBIT. At first we're going to assume no additional debt, no less debt. and no change, or I guess we've assumed no change in the interest rate we're paying. So we put our interest costs at $5,000, same as the year before. That gives us earnings before taxes of $4,900. Tax at 40% is $1,960. So our net income will be up to $2,940. So there's a pro forma income statement. Now the only thing we have to do now, we've got to reconcile this with our balance sheet. Because of our balance sheet, we're going to need more assets to support greater sales. And we have to ask ourselves, where are those assets coming from? Is there enough in retained earnings to finance that, or are we going to need to add more debt? So let's take a look. On our balance sheet, we have current assets, and this is the prior year, $10,000, net plant, property, and equipment, $48,000, total assets, $58,000, current liabilities, long-term liabilities, equity at $10,000, total $58,000. So our balance sheet balanced. Now, look at the next year. Our current assets as a percentage of sales. Well, if we assume the percentage of sales stays the same at 33%, then the current assets need to increase the same amount as sales, 10%. So we need another $1,000 there. Finance inventory and receivables. Our net plant, property, and equipment, that was 160% of sales. We'll assume it stays the same, so that goes up by 10% as well to $52,800. So we've got another, what, $4,800 to finance there. So our total assets are now up 10% at $63,800. We assume our liabilities will also go up the same as sales, 10%. We're leaving initially our long-term liabilities the same. Equity has gone up. Why? Equity's gone up by the amount of our retained earnings. We're assuming we didn't pay any dividends, so that increase, that earnings on the previous slide, $2,940, we add to the $10,000, so our equity goes up by $2,940, our retained earnings. We add all that up, but we find out that our liabilities and equity is smaller than the assets. What's going on? Well, we're going to need to raise some money to fund this growth. We haven't got enough in our liabilities and our equity in order to fund $63,800 of assets. So now we've got to do something about that. And we refer to this as reconciling the balance sheet and the income statement. So we've got more assets than funding by $2,560. So what could we do? Well, we could issue debt or we could issue equity. If we issue debt, we're going to have additional interest costs. Interest goes up, net income and retained earnings go down. So we wouldn't really be reconciled. We'd have to do it multiple times. If we issued equity and there's dividends on that equity, that would also reduce retained earnings, and we wouldn't really balance out exactly after one round of that either. Now, if the equity doesn't pay any dividends and we say, well, yeah, the way we want to fund this is issuing equity, well, then we're done. We can make our balance sheet balance. Equity goes up, liabilities plus equity equals total assets, and we're done. But if we're using any funding sources that have charges on them that can reduce retained earnings, then we have to do multiple passes here. So either our equity is reduced and this requires more funding, so we just repeat the process to reconcile the income statement and the balance sheet. So we say, okay, well, now we're a little short. Let's issue a little more debt. Interest cost goes up. We run a little short on retained earnings. We go round and round until it balances. And the assets we've got to fund the sales we're projecting just equal the liabilities and equity on the balance sheet. So then we've completed our pro forma financial statement.